Hi, in my last video I looked at the price-earnings ratio, which is a really widely used investment ratio by private investors. Problem is the ratio has several flaws, the biggest of which is it doesn't take a company's debt into account. So in today's video I'm going to look at a different ratio, the EV/EBIT ratio, which does take debt into account. So let's crack on and look at what the ratio actually is. So EV/EBIT, it stands for enterprise value over earnings before interest and tax. We looked at enterprise value in a video why you should focus on enterprise value, but basically it's market cap plus the company's net debt. And then on the bottom we've got earnings before interest and tax, or EBIT, which is roughly the same thing as operating profit. So let's do an example now. Let's look at Marks & Spencer's. So just before I started filming this interview, the share price was £4.43. Last year's earnings per share was 33p. So that means its PE, its price earnings ratio, is 13.4. And if you knew nothing else about Marks & Spencer's, you'd say that means the company is sort of neither particularly expensive nor particularly cheap. But of course the price earnings ratio doesn't give you the whole picture. One thing it's missing is the debt situation. So let's look at how much debt M&S has. So it's got roughly 2.2 billion in debt. So we have a market cap of 7.2 billion. We add on the net debt and we get an enterprise value of 9.42 billion. So that's the top of the ratio. Then we need the EBIT, the operating profit, of 790 million. We put that on the bottom of the ratio and we get an EV/EBIT of 11.9. And that's compared to a price earnings ratio of 13.4. So you probably noticed the EV/EBIT ratio is a bit lower. That's normally what you'd expect, that's fine. And the crucial point is if you compared Marks & Spencer's to another retailer, let's say that other retailer had way more debt, using the EV/EBIT ratio for both companies, you'll get a more accurate, a fairer comparison between the two companies, whereas the PE ratio won't bring out the fact that Marks & Spencer's rival has way more debt. Now, if you think I'm talking gibberish, let's look at another example now, and hopefully that will make things clearer. So this time we've got two fictional companies, going to call them Company A and Company B. Just to make things simple, neither company is paying any tax. Now their pre-tax profits, or their profits before tax, were 100 million last year. And their market cap, the total value, was £1 billion. Now, because they're not paying any tax, their pre-tax profit is the same as their post-tax profit, the same as their earnings. So we can get their PE ratio just by dividing $1 billion by 100 million. They've got a PE ratio of 10. So seemingly up to here on this chart, both companies are absolutely identical. But the difference is Company B has no debt, whereas Company A has £200 million worth of debt. And that means the EV, the enterprise value, is different. Company B has no debt, so the EV is $1 billion. Company A has 200 million of debt. Add that to the market cap, we get an EV of 1.2 billion. So if we're looking at both companies now down to here, Company B does look the more attractive because it's got no net debt and it's generating the same amount of profit. And what's going to happen now is the EV/EBIT ratio is going to confirm that picture. So let's calculate the ratios. For Company B, the enterprise value is $1 billion, same as market cap, no debt. So we'll divide by EBIT, 100 million, because it's the same as the profit before tax, because no tax is being paid, no interest is being paid. So the EBIT is the same as earnings. So EV over EBIT, $1 billion divided by 100 million, we get an EV/EBIT of 10. With Company A, the EV is different, 1.2 billion, and the earnings before interest and tax, the EBIT is also different, it's 110 million. And the reason is Company A has 200 million pounds in debt. Let's say it's paying 10 million pounds in interest on that debt. we then need to add that interest on to the pre-tax profit figure to get the EBIT figure. So we add the £10 million interest onto the £100 million profit, and we get an EBIT of 110 million. So we divide 1.2 billion, the EV, by the 110 million EBIT, and company A has an EV/EBIT of 10.9. So we look at both companies, we see company B's got the lower EV/EBIT, it's the cheaper company. And so we can use this comparing loads of different companies and getting a quick ready reckoner answer which compares the company's profitability with its valuation, just like the price-earnings ratio, but also includes the debt situation, and you only get that from EV/EBIT. So I hope you found that useful. I do think the EV/EBIT's a ratio that should be more widely used. I'll be back with another video soon, so until then, good luck with your investing.